foreign capital flows and India's balance of payment. Why this is in news? India has emerged as world's fastest growing major economy, recording an average annual GDP growth of 8.2% from 2021 to 2024, outpacing countries like Vietnam, China, United States. Despite strong growth, India faces a low net foreign capital inflow, reflecting a gap between GDP expansion and investor sentiments in its balance of payment. What is balance of payment? Balance of payment serves as crucial economic indicator. It is a crucial economic indicator detailing all financial transactions between India and rest of the world. This comprehensive ledger tracks the inflow and outflow of money, where inflows are marked positive and outflows are negative. Inflows are positive, outflows are negative, reflecting the India's economic interactions globally. It measures the relative demand. It measures relative demand for rupee against dollar, yen, and other foreign currencies, crucially influencing exchange rates and economic stability. What are the components of balance of payments? First component is current account. Current account, trade of goods, trade of services. Current account includes the trade of goods, tracks the physical imports and exports, indicating the balance of trade. A deficit suggests highest import than export. Trade of services, that is invisible, include sectors like IT, tourism, remittances, contributing positively to India's current account surplus despite trade deficits. The net of these two components determines current account balance. Second one is capital account. What is capital account? Which captures the investment such as foreign direct FDI, foreign direct investment, foreign institutional investment, that is FII, essential for economic growth and stability. Capital account flows reflects the factors such as commercial borrowings, banking, investment, loans, capital. This is the flow chart of balance of payment, which include current account. Second is capital account, in which export and imports of good. In current account, export and imports of goods. And second one is banking services, factor income such as employee compensation, investment income, that is profit, interest, dividend on the assets from abroad. That is third one is gifts, grants and remittances, transfers. In capital account, FDIs and FPIs, loan, ECBs, banking capital, NRI deposits. This is flowchart, which is more important. What is the current state of India's balance of payment? First is trade deficit and invisible accounts. India's trade deficit continues to widen, reaching its $287.2 billion US dollar in 2024 and 25. However, this has been offset by surpluses in invisible account, primarily due to service exports and remittances from the Indian diaspora. These surpluses have helped maintain manageable current account deficit even as merchandise trade deficit balloon. Second one is growth and investment paradox. Despite robust growth, India has faced challenges in attracting foreign investment. In financial year 2023-24, foreign portfolio investments, FPIs, amounted 25.3 billion US dollar. However, India experienced significant net outflows in previous year with 5.1 billion US dollar in 2022-23, 14.6 billion US dollar in 24-25 and 2.9 billion in 25-26 as of September. This trend highlights paradox where India's economic expansion does not align with foreign capital influx. India's economic expansion does not align with foreign capital influx. Next point is private equity versus venture capital exists. The increase in exits from private equity and venture capital investments reflects the profit booking and matured investments rather than new capital creation. Total value of venture capital exits 24 US dollar in 2022. In 2024, 33 billion US dollar. Foreign investor prioritize corporate earnings, overall business climate and market valuations over the headline GDP growth figures. What is FDI and FPI? Foreign direct investment. The investment made by foreign entities or individuals in businesses, assets located in different countries. FDI routes, that is first one is automatic route, no prior government approval required, up to 100% allowed in non-critical sectors. Second, government approval necessary in certain sectors for investment, administered by Department of Promotion of Industry and Internal Trade DPIIT and RBI. For example, approval via auto and government route, banking private sector up to 49% automatic route plus above 49% and up to 75% government approval is required. In defense sector, up to 74% from automatic route, above 74% government approval is required. In healthcare brownfield, up to 74% from automatic route and above 74% government approval required. In telecom services, up to 49% automatic route and above 49% government approval required. Foreign Investment Promotion Board FIPB comes under Ministry of Finance, responsible for processing FDI proposal facilitated by Foreign Investment Facilitation Portal, making recommendation for government approval. Government's prior approval is mandatory for FDIs from countries sharing land border with India, that is China, Bangladesh, Pakistan, Bhutan, Nepal, Myanmar and Afghanistan. This was important. India's top FDI sources first is Mauritius, Singapore, USA, Netherlands and Japan. In financial year 2022-23, India's top sectors attracting FDI in financial year 2022-23 is service sector, computer, software and hardware, trading, telecommunication, automobile industry. Foreign portfolio investment. Investments made by foreign individuals, institutions or funds in financial assets known as fly-by-nights and hot money. Important feature: purchase of financial assets occur without gaining ownership. Passive investment approach: investors earn returns through dividends, interest and capital appreciation. For example, stocks, bonds, etc. Regulatory body is SEBI, Securities and Exchange Board of India. What are the difference between FDI and FPI? Nature of investment in FDI is a long-term investment, FPI is a short-term investment. Objective: long-term presence in foreign country. FDI earning quick returns from investment of FPI. Control: significant over the invested entity. No or limited control on invested entity. Investment in tangible assets like factories, buildings. Investment in financial assets like stocks and bonds. Returns, profits, dividends, and capital appreciation. Returns, dividends, interest, and capital appreciation. Policy regulation, government policies and sector specific regulation. Policy regulations in FPI, flexible regulations, and easy entry or exit. Impact on economy. FDI, job creation, technology transfer, and economic growth. Short term liquidity, impact on stock market performance. Previous year question. With reference to investment, consider the following 2025: bonds, hedge funds, stocks, venture capital. How many of these above treated as alternative investment fund? Venture capital fund, private equity fund, real estate fund, hedge funds are alternative investment funds. So option B is correct.